In this video we're going to look at QS6-5 from the textbook. As you can see here, I just reproduced a copy of it. And we're going to look at how to record just two of the transactions. I'll leave two for you to try. The solution, complete solution for this is posted as a PDF file on the website. So we're just going to look at the purchase of inventory on May 15th and the payment for that inventory on May the 30th. And we're actually going to take a discount on that. And what we're doing here is we're working with a system that has, this company uses a perpetual inventory system. So we're going to journalize each of the following transactions assuming perpetual inventory system. So how does a perpetual inventory system work? Well, it means we perpetually or continuously update the inventory file, merchandise inventory, and the cost of goods sold when we sell it. In this, since we're just buying inventory, we're only going to update the inventory account. So that first transaction on May the 15th, just to look at it again here, that first transaction, we purchased $3,000 of merchandise inventory, and the terms were 2, 15, and 30. And that means if we pay within 15 days, we get a 2% discount. So a 2% discount if paid within 15 days. Otherwise, the entire amount is due, or the net amount, the total amount is due in 30 days. So we don't know whether we're going to pay in 15 days. So we just record the full cost of the merchandise. And the way we record that is on May the 15th of whatever year this is, May 15. We bought some inventory, so now it's an asset. It's we own it. We've taken delivery of it, and so merchandise inventory gets increased. And because that's an asset, an increase is a debit. Merchandise inventory goes up by, in this case, $3,000. Now we didn't pay for that inventory, so of course then we have a liability, and that would be accounts payable. For $3,000 to record inventory purchased, and I'll just put in the 2, 15, and 30 here to indicate that, to remind us that we get a 2% discount if we pay within 15 days. So some time passes and other things happen, and we've probably recorded a bunch of other transactions, and it rolls around to May 30th, and we decide we're going to pay on May the 30th, and because that will entitle us to the 2% discount. So on May the 30th, we are going to pay these people what we owe them, and what we owe them is $3,000. So we're going to settle that debt. So we need to reduce the amount that we owe to this supplier by the $3,000. So we debit accounts payable for the entire amount that we owe them, the $3,000. But here's the thing. We're not going to send them $3,000 in cash because we're entitled to a 2% discount. And 2% of $3,000, $2 on every 100, there's $3,000 there, so that's a $60 discount that we're entitled to. So we're only going to send them $2,940 in cash. So cash, we're going to add the actual check will be written for $2,940, being the $3,000 minus the $60 discount. But our debits don't equal our credits now, so we still need that $60 to go somewhere. It's not a reduction of cash. And here's the explanation. The account we're going to hit with that $60 is merchandise inventory. Now we didn't sell any of the inventory. That's not why we are reducing the inventory account. But when we bought the inventory, that inventory, we thought it was going to cost us $3,000. But we got a discount on it, so in fact it didn't cost us $3,000, it only cost us $2,940. So the inventory account, if we looked at the T account for that, the T account for that would look like this. Inventory on May the 15th, we added $3,000 into the inventory account. which tells us that we bought inventory and it cost us $3,000. But when we took the discount on May the 30th, that discount actually reduced our cost by $60, and so in fact that inventory really only cost us $2,940. This was the transaction to put the full cost in the first place, and on May the 30th this was part of the transaction that reduced that cost by the amount of the discount that we took. And we always wait until we actually take the discount. We don't do it at the time we buy it because, like I said, we don't know for sure whether we're going to pay it in 15 days. We might get to 2 weeks from now and find out that we don't have the money to pay it, and so we wouldn't pay it. Or there might be other reasons, but we don't know for sure whether we're going to pay it at the time that we bought it. So this is to record payment for inventory taking the discount allowed. Alrighty. So this shows you how to do it if we're taking a discount. If we hadn't been entitled to the discount, if we had been too late, if it was after 15 days and we didn't take the discount, then the only difference in this transaction would be we still paid off the $3,000, except that now it would take a whole $3,000 in cash, and there would be no entry to merchandise inventory to reduce the cost. The inventory would have cost us $3,000. So armed with this, you should be able to start to tackle exercise 6.3, which is a number of transactions related to the purchase of inventory, some of which we get discounts, some of which we don't. So when we purchase, it looks like this. When we pay for it, it looks like this. When we get a discount, and if we don't get the discount, then it's just accounts payable and cash for the full amount. So good luck with that.